Hi, I'm Stacy from FundCalibre. For our third video of this recession series, we're talking about how you can invest through an economic slowdown. Stock markets, unsurprisingly, suffer during a recession. If the economy is struggling, then businesses are struggling. This affects investor confidence and share prices. As stocks become less attractive, money tends to flee equities during a recession to be deployed into more defensive areas. That can involve anything from investors deploying their cash in safe havens like gold rather than equities, transferring their investments overseas, or pulling their cash out of the market altogether. This recession is a self-induced recession, and like no other we've experienced before, no one knows how deep it will go or how long it will last. So above all, diversification of investments will be paramount. In a volatile and uncertain environment, you don't want to lose too much as and when markets fall, but you don't want to miss out on any rallies either. Here are a few ways you can achieve that diversification. Firstly, we have a few defensive options. For the defensive part of the portfolio, investors could opt for an absolute return fund like Janus Henderson UK Absolute Return or Smith & Williamson Enterprise. They invest in UK equities, but they can also make money from falling share prices. Mark Swan, co-manager of Smith & Williamson Enterprise, told us how he used shorts in the lead-up to the March stock market falls.
Yeah, obviously the shorts were very profitable in this period, helping offset losses on the long side. How we positioned, we were pretty cautious coming into March. Our concerns were that we'd had the longest bull run in market history, and hedge funds were pretty aggressively positioned coming into this as well. High nets, high grosses. This was a risk that we were concerned about. So we were pretty cautious coming into this, having a low net, and those shorts in the most cyclical names and the most indebted were highly profitable. They were the ones that got hit the hardest.
Bond funds are another defensive alternative. Bond markets fell along with stock markets in March, but to a lesser extent. In a world where interest rates are now likely to be rock bottom for another decade, their increased yield may also be attractive for those perhaps looking to fill the income gap left by dividend cuts. Man GLG's Strategic Bond and Nomura Global Dynamic Bond are two very versatile bond funds. Physical gold is also an option, as it tends to be the asset investors turn to in flight to safety and can give some protection in both inflationary and deflationary environments. Marion Gold and Silver can invest in both physical gold and silver, as well as gold and silver mining equities. Or you could choose to go on the offensive. Technology companies have done well in this crisis, as we've all had to do far more online. Believe it or not, such is their dominance that at one point in April, the US NASDAQ index enjoyed a market capitalization greater all the developed markets outside of America. Or to bring that example a little closer to home, Amazon and Alphabet combined were more highly capitalized than all the quoted British companies put together. As James Thompson, manager of Rathbone Global Opportunities, so nicely put it, working from home technologies to deliver to home food and purchases and fun at home entertainment packages, we've rallied on technology more than ever. AXA Framington Global Technology Fund is an obvious choice here, but many more generalist funds also have large allocations to the sector, like Schroeder Oriental Income and Guinness Emerging Markets Equity Income. Or finally, you could always let the professionals decide for you. If trying to combine all that is too much for you, you could let the professionals decide instead and opt for a multi-asset, multi-manager fund like Premier Multi-Asset Growth and Income or Close Managed Income. Want to learn more about what recession means for your finances, visit fundcalibre.com and simply search recession to see what we've already discussed, and don't forget to subscribe for more information.